Things did not get better. What's going on, team? It's Ricky with Techman Solutions here with a quick little stock market update. CPI data was released today. We actually live streamed it. So it's actually the video right before this one if you go to my YouTube channel. We live streamed it. We saw how the market reacted. The market dropped instantly about 3 to 4%. And then a lot more selling pressure happened about, I would say, 15 to 20 minutes shortly after. So I'm going to start sharing my screen so you guys can see exactly what it is that I'm looking at. I wanted to break it down in a more simplistic way. That live stream is about 38 minutes long. I understand that not everyone has 38 minutes. So I want to explain to you what happened. So inflation, or the CPI report, put inflation at 8.6% for seasonal adjustment, meaning the last 12 months. With that being said, we know that 2 months ago when it was reported, we thought that inflation peaked at 8.5%. This is what everyone hopefully was anticipating. The month after, we saw 8.3%. Not as good as we wanted it, but progress, right? From 8.5 to 8.3. Today, for last month, we saw 8.6%, showing that inflation did not peak. Inflation is at a 40-year high and worse than expected. Ergo, why the market dropped and why TQQQ is down 8 to 9%, right? Everything's down right now. If I'm not mistaken, even oil stocks are down and in the red, right? So it's not necessarily good for anyone. But what I wanted to break down is, well, how do they come up with the 8.6%? So, and where does most of this weight come from? One of the things that you guys should and be able to clearly see is these are all of the items that are taken into consideration, all of the main items that are taken into consideration for the CPI report. They look into food, they look into energy, they look into commodities, they look into services and transportation, right? Transportation service, stuff like that, right? If I were to ask you for the month of May, right? This is month of May, this was last month, March, right? All of that good stuff. This is what was reported. And all they look at is the month over month change. So we saw an increase here for all items of 1%, right? We can see that some food items, yep, we saw a nice little jump, but in the low single digits, not really much of a surprise. It's not until you get in here, right? The energy sector, surprise, surprise. We could see 3.9%, 4.5%, 4.1%. 16.9% for fuel oil. 16.9. And again, if we look at the overall seasonal adjustment for the past 12 months, this is in the triple digits. 106 for fuel and oil. There's not one that is relatively close to this. The closest one is half of it. And if I'm not mistaken, it's energy commodities, right? Which is right under the same sector. Energy commodities, we got gasoline, all types, and then we have fuel and oil. The market leaders when it comes down to, again, inflation. This is where I see most of the weight being. And I wanted to quickly comment on this because, you can go down the list and we did see some decent jumps right on over here with used car prices. Last month, we were seeing a decrease for about 3 months in a row. And then last month that was reported for the month of June, we saw a 1.8% increase, meaning that used car prices are going back up. And the only other thing is transportation services, surprise, surprise, right? Airlines, all of that stuff. It makes sense that as oil prices are going up, it's going to have an influence on that. So overall, an increase of 1%. And if you look at these numbers, there's not one that actually retracted. Last month, we saw a couple, different areas, especially in the energy sector where there was a lot of weight actually retract, meaning that the month over month difference actually was negative, which was good. Right? That means that we were chipping away. This month is the exact opposite. Now, the reason that this is concerning, and again, just hear me out and please share your comments down, or your opinions down in the comment section. This is just my opinion. I understand that inflation, right, especially when it comes down to housing prices, rental rates, all of that stuff, right? We must raise interest rates to be able to really slow down the economy to some degree so we can catch up with inflation, right? So these interest rates do have to rise. The thing that people continue to talk about is they're blaming the feds, they're blaming the feds, they're blaming the feds. But if you look at everything, it's really oil prices that make up most of that CPI data, right? That make up, they're the biggest outlier. They're in the double digits and some triple digits when it comes down to the past 12 months of the seasonal adjustment of inflation. So the feds can't come up with any oil or energy policies. You're aware of that, right? So my question is, how do we expect to fight the price of oil, which trickles down into retail, which trickles down into transportation services? It trickles down into every avenue and area, right? How are we supposed to fight this form of inflation if we don't have a solution for the actual root cause of it? What's the actual root cause? Well, oil prices. And yes, oil prices can be much worse, but they've been bad for the past 4 months. Now, a lot of people are like, we should start chipping away into our oil reserves. I understand that United States oil reserves, majority of it is used for, worst case scenario, war, stuff like that, right? And or really, really bad oil prices, right? I guess we're not there yet, and rightfully so. I think the average is right below $5 a gallon in the United States. With that being said, it's been 4 months, and there's been a series of different plans to accommodate our current demand issue, and yet nothing has been done. There is supposedly this Venezuela deal that within 2 months, back in February and March, that they can get us back to, demand level. Yet nothing has been done. And if you think about how that all trickles down into the different areas that we're seeing this inflation, why are we trying to raise interest rates to fight back inflation when the actual root of the cause is something completely different? When it comes down to what has the most influence, at least for the past 12 months, for the CPI data report? That's kind of my question. And again, if I'm wrong, please let me know. My biggest thing is I just think that there needs to be a solution, or at least something in the works being put in place for oil prices because of how much of an influence and the domino effect it has in our overall economy and how it is causing prices to rise. But it's not just because of rising prices because of inflation. It's because there's such a low supply of oil. And that's what we need to fight against or have a solution for. At least that's the way that I see it, right? I know that when it comes down to the housing prices, 100% raising interest rates does aid that. No question about it. Yes, the same thing with retail. Yes, the same thing with a lot of the things that we don't necessarily need. But when it comes down to oil prices, especially more now than ever before, do we just expect people not to have to commute to work? Not have to travel to wherever it is that they need to travel? Transportation services no longer use oil. I saw this article today of there's a specific area in the United States that this police station doesn't have enough funding for their fuel cost that they can't actually drive to all of that. And this must be an extreme example, that they can't actually respond to every 911 call that they are receiving now because of how expensive gas prices are. And again, this is probably an extreme example, but my biggest thing is just how have we not come up with any form of solution? We continue to say that, the U.S. is, one of the world's largest producers. Great, but majority of it goes to the reserves, right? Supposedly Biden is releasing 1 million barrels per day, but our consumption level is closer to 20 million barrels. It's imagine using a Band-Aid on a huge wound. It just wouldn't make sense. It's not going to do anything. I think that there has to be an actual solution put in place where we begin to import the same way that we were before to be able to keep up with current demand levels. And I don't think that raising interest rates will fight the root of the cause, which I view to be oil as of right now. That's just my 2 cents. But that's kind of a little bit, I guess, on a tangent. I have to head on over now to the HQ. I'm going to be having an in-person session with some of our Learn Plan Profit members. I'm excited to share that with you guys. Also, friendly reminder, if you guys ever want to stay connected, I do have a free trading group chat. That's going to be that first link down in the description. But if you want the ability to watch me trade live every day, I do trade live Monday through Friday, anytime that the market's open. I'm there. And if you want to join us as soon as Monday, the second link down below is a $100 off coupon. gives you access to the A to Z video lesson library, my daily live trading sessions, gives you access to our private group chat, and yes, it gives you access to our Tech Buds HQ located in Chandler, Arizona. It's a one-time payment, lifetime access, and today it's $100 off. And again, that's that second link down below. I appreciate you guys' time. I hope that it earned a thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take it easy, team.